Welcome back to Singapore Property Talk Law. Today we're going to do a deep dive into a story that's really shaken up Singapore's fintech scene. It's the rise and fall of chocolate finance. Joining me to break it all down is Serene, our expert on all things finance. Serene, thanks for being here.
Glad to be here, Damien. It's a fascinating case study for sure.
Absolutely. So for listeners who might not be familiar, let's start with the basics. Chocolate Finance is a wealth management platform, and they were making waves with that unique Visa debit card of theirs. Yeah, they promised some pretty incredible miles rewards through their partnership with HeyMax, a popular loyalty program here. But things took a pretty dramatic turn recently.
Yeah, it's leaving a lot of folks wondering if what seemed too good to be true actually was. Serene, what was it about Chocolate Finance's initial offer that made it so appealing? Well, they really tapped into that Singaporean love for travel miles. They were offering like an unprecedented 2 max miles for every dollar you spent, capped at $1,000 a month. And here's the kicker: they were rewarding spending on things that are usually excluded from those sorts of programs. Like bill payments through AXS, donations, even education fees. I mean, it was practically unheard of.
Yeah, it was quite a deal. And to add to that, HeyMax miles are pretty flexible, right?
Yeah.
No expiry, and they're transferable to a bunch of different airlines and hotels. A real catch for anyone looking to, really maximize their travel rewards.
Exactly. Yeah, you could even use them for flights through HeyMax's Fly Anywhere option.
Yeah.
So yeah, it's no surprise that Chocolate Finance kind of generated a huge buzz initially.
Yeah, totally. But this attractive offer, however, had some pretty unforeseen consequences. What was that strategic error they made that led to things unraveling so quickly?
Well, it seems like Chocolate Finance didn't really anticipate how some users might game the system. Specifically, they overlooked the potential for exploiting those AXS payments. For those unfamiliar, AXS is a widely used electronic payment platform here in Singapore. And the thing is, Chocolate Finance wasn't charged any transaction fees for those payments made through AXS.
And that's where the trouble began. Some savvy users figured out that they could make absolutely massive AXS payments.
Yeah.
Yeah, they were essentially racking up huge amounts of max miles without, actually incurring any real costs for themselves.
Right. It was like a classic case of exploiting a loophole. We've seen this kind of thing before in the world of reward points. Companies often have to adjust their programs after users find creative ways to maximize their gains.
Yeah, I can imagine that happening quite a bit. So instead of maybe tweaking the program or communicating those changes clearly, Chocolate Finance just abruptly disabled AXS payments without any warning.
Mm.
And let's just say it led to some customer dissatisfaction.
Yeah. That's putting it mildly, I think. They initially tried to kind of shift the blame to AXS. They worded their FAQs in a way that implied that it was, AXS's decision, and that just added fuel to the fire.
Yeah. Instead of being transparent, they kind of tried to deflect, and that eroded a lot of trust. Didn't it?
Absolutely. And in, a sector like finance where trust is so paramount, that's a pretty critical misstep, this lack of transparency. And then that sudden change, it triggered a wave of panic, really.
It definitely did. And that brings us to the next chapter of this saga, the mass withdrawals and that suspension of their instant withdrawal service. But we'll delve into that in part 2 of our deep dive.
So, Serene, as if that whole AXS situation wasn't enough, Chocolate Finance was also promoting its chocolate liquidity program, which allowed for instant withdrawals, like up to $20,000 a day. It seems pretty unusual for a non-bank, financial institution. It does, yeah. And this is where things get even more interesting. They were essentially operating this separate fund to support those instant withdrawals. And when a bunch of customers, spooked by that whole AXS issue, started withdrawing their funds all at the same time, well, this pool of liquidity got strained.
Yeah. So it sounds like they kind of inadvertently created a classic bank-run scenario, even though they aren't a traditional bank.
Precisely. And this highlights the inherent risks of offering such unconventional service. While Chocolate Finance keeps saying that customer funds are safe and invested appropriately, the perception of risk can be just as damaging. Panic can spread pretty quickly in these situations.
Oh, yeah, For sure. And adding to the pressure, the Monetary Authority of Singapore, MAS, stepped in. They instructed Chocolate Finance to ensure orderly redemption of funds and to keep customers informed. And they're also looking into whether Chocolate Finance misrepresented its instant withdrawal program.
Yeah, this is significant because it shows that regulators are taking notice of these innovative financial products, even if they don't fall under, traditional banking regulations. It sets a precedent for future scrutiny of these fintech companies that are kind of pushing the boundaries.
Absolutely. So with their reputation taking a hit and MAS breathing down their neck, what's the likely future for Chocolate Finance? Can they recover from this?
Well, their CEO, Walter de Oude, has stated that they are fulfilling withdrawal requests within, standard industry timelines, typically 3 to 5 days. And he is also, emphasizing that customer funds are safe and that they are committed to rebuilding trust.
But actions speak louder than words, right?
Yeah.
What concrete steps could they take to really regain customer confidence?
Transparency is key, really. They need to clearly communicate their financial standing, their investment strategies, and the safeguards they have in place to protect those customer funds. They also need to demonstrate a commitment to responsible innovation, maybe by involving regulators in the development of future products, for instance.
It's a tough road ahead for them. This incident has definitely sent shockwaves through the fintech industry in Singapore. What are the broader lessons that other startups can learn from Chocolate Finance's experience?
It's a cautionary tale about the importance of balancing innovation with prudence. Thorough risk assessment, robust compliance procedures, and clear communication with customers are non-negotiable. The allure of rapid growth can't overshadow the need for responsible financial practices.
Yeah. This also serves as a reminder for consumers to be diligent. We often get enticed by those, attractive high-yield offers, but it's crucial to understand the underlying mechanisms of potential risk before jumping in.
Absolutely. Sometimes a deal that sounds too good to be true is just that. It's important to ask questions, read the fine print, and consider the company's track record.
So while Chocolate Finance works to regain its footing, this whole situation raises a bigger question. Can these incredibly generous miles reward programs be sustainable in the long run, or are they inherently flawed?
That's the million-dollar question, isn't it? It'll be fascinating to see how Chocolate Finance adapts and if they can find a way to reward customers without, jeopardizing their own stability. This whole incident could be a turning point for how these programs are structured and regulated in the future.
And on that note, we'll wrap up part 2 of our deep dive into the Chocolate Finance saga. But we're not done yet. In part 3, we'll zoom out and explore the wider implications for the fintech landscape in Singapore and what this means for you as a consumer. Stay tuned. All right, Serene, we've covered Chocolate Finance's roller coaster journey, from promising startup to cautionary tale. Now let's zoom out and take a look at what this whole saga really reveals about the bigger picture of fintech here in Singapore.
Yeah, I think this incident really highlights the tension between rapid innovation and the need for robust risk management in the sector.
That's a really interesting point. Could you elaborate on that a bit more?
Sure. Well, on one hand, you've got this dynamic market like Singapore. Consumers here are pretty tech savvy, and they're always on the lookout for that next great deal. And this creates a really fertile ground for fintech companies to introduce innovative products and services, and they're often pushing the boundaries of what's traditionally been offered.
And Chocolate Finance, with their super generous rewards program, certainly seem to tap into that desire for both novelty and value.
Exactly. But their approach, while it was successful in attracting a large user base really quickly, also exposed a pretty critical vulnerability. They seem to have underestimated the potential for exploitation, and they didn't have those adequate safeguards in place.
So it's almost like they were so focused on disrupting the market that they kind of overlook some fundamental risk management principles.
Yeah, it's a pretty common pitfall for startups that are eager to make a splash, but as we've seen, this can have some pretty serious consequences, not just for the company itself, but for that broader trust in the whole fintech ecosystem.
Right, that makes sense. So what are the key takeaways here for other fintech startups that are looking to innovate in this space?
I'd say this incident really underscores the importance of having a robust compliance framework, like from the get-go. Don't just chase growth at all costs. Engage with those regulators early on, seek expert advice, and thoroughly assess the potential risks associated with any new product or service.
And transparency is paramount, right?
Yeah.
Especially when you're dealing with people's finances.
Absolutely. Clear and open communication with customers is it's just crucial. Explain the mechanics of your product, the underlying risks, and those safeguards you've got in place. Don't try to hide potential downsides or use any ambiguous language.
This incident also seems to raise questions about the long-term viability of these incredibly generous rewards programs. Can they really be sustainable?
It's a valid question, and it's one that the industry is going to need to grapple with. Chocolate Finance's plan to reinstate those instant withdrawals without AXS suggests that they're trying to find a balance. They'll likely need to rethink their reward structure, maybe by setting stricter limits, excluding certain types of spending, or finding alternative ways to generate revenue.
Essentially, they need to make sure that they're rewarding those customers without incentivizing behavior that
Yeah.
could undermine their own financial stability.
Exactly. It's about finding a sustainable model that benefits both the company and the consumer. This incident could lead to a shift towards more responsible and transparent reward programs in the long run.
So for our listeners who are intrigued by these new financial products and services, what's the key piece of advice that you'd offer?
I'd say approach everything with a healthy dose of skepticism. Do your research, understand those risks involved, and don't be swayed by promises that sound too good to be true. I mean,
Yeah,
if
yeah.
something seems unbelievable, it probably is.
Great advice, Serene. The chocolate finance saga has certainly been a learning experience for everyone involved. It really highlights both the exciting possibilities and the those potential pitfalls of this whole fintech revolution.
It certainly does, and as the lines between traditional finance and fintech continue to blur, it's more important than ever for both consumers and companies to navigate this landscape with caution and awareness.
Well said. Thanks for joining me today, Serene. This has been a really insightful deep dive into a very timely topic.
It was my pleasure. Always happy to unpack these complex issues.
And for our listeners, remember to stay informed, do your due diligence, and keep exploring that ever-evolving world of finance and property here in Singapore. Until next time, stay savvy.